recipes for technical trading success in Cook's Kitchen.
Who's afraid of the stock market bubble? Well, apparently Morgan Stanley is. This is what I wrote for my Taser subscribers last night, Tuesday, July 13th. Morgan Stanley says there's a 15% correction coming. This is from their chief investment officer of the wealth management arm, Lisa Shallett. And I'm just going to go right to her data chart because this basically says it all. It seems like she's ready, says we're partying like 1999 here on valuations. And she's just using a simple price to sales. On the left axis, so over here, is the S&P Information Technology Index. So that would be the darker blue is trading, let's call it 7.5 times sales. Yeah, that's rich. I mean, we've been talking about this for a year, how, software valuations, you've got a lot of SaaS companies trading 20 times sales, 30 times sales, 40 times sales if they're growing over 50 or 60%. So that makes the whole IT index trade at 7.5 times sales, which is almost to the bubble peak of 99-2000. So that's what the folks at Morgan Stanley are watching. On the right axis, the lighter blue is the whole market, the S&P 500 trading. We'll call it 3.5 times sales. Also rich compared to our last big bubble standards. New highs basically in the price to sales ratio. And just a caveat here, Morgan Stanley, she works with Mike Wilson, who is, I believe, chief equity strategist, and he's sort of I don't want to call him a perma bear, but he tends to be cautious. I followed him a lot in 2018, 2019, and he was right about a lot of stuff, and then he just stayed bearish and missed the rally of 2019. I think he was probably a buyer at the 2020 Corona crash lows. All right, so what we're going to do is we're going to talk about, if you should be afraid of this bubble. And one of the big ifs is inflation, right? So let's take a look at the 10-year yield real quick. The bond market does not seem afraid of inflation. Here we are back under 1.4% on the 10-year yield. And the Fed, there's chatter about the Fed may have to do something about inflation, but it doesn't look like it, right? I mean, the short rates aren't telling you that. The curve's not going inverted. I want to show you a contrary thesis, and that's from the head of the largest asset manager over at BlackRock, Larry Fink. Let me see if I can find this. I just saw it this morning. There he is. BlackRock CEO, Larry Fink, does not see inflation as transitory. In other words, he thinks inflation is here to stay. He says, I'm not calling for 1970s inflation. I just think we're going to have above 2% inflation, probably closer to 3.5%, 4%. Now, the Fed is going to let it run hot. I mean, I think the Fed will let, short-term inflation measures, CPI, PCE, go to 2.5%, 3%. But if you listen to Larry Fink, 3.5%, 4%, yeah, that's really hot. And that could bring some Fed policy changes sooner than we think. So is he right? And how do you want to play it with equities? Well, all depends on your time frame. If your time frame is pretty short, then you should listen to Lisa Shallett at Morgan Stanley and Larry Fink, and have some hedges or reduce some risk, take some profits. But I want to look at the bigger picture of deflation versus inflation, and that would lead me to a piece I wrote in December of 2017. That I titled The Technology Supercycle. This is for Zacks Confidential, so this is a subscription service. You can't see the whole thing, but I recapped it in I think May of 2018. I recapped it as a video. So if you just Google search Technology Supercycle, you should either find my video on YouTube or this article on Zacks.com or somewhere. And it's got a ton of great information. And what I was trying to do was figure out, what was going on. Where was inflation? The inflation was missing in action, and productivity seemed to be hidden. And so those are the things I was trying to answer. My thesis at the time was that technology was accelerating growth, but we didn't see it in the government data because productivity was also accelerating in ways uncaptured or unpublicized by the Bureau of Labor Stats, thus changing both the numerator and denominator of several derivative measurements. And I got some great, and I'm thinking about the technology that, from the cloud to mobile, to AI to automation, these things were ramping productivity for lots of industries. So I got some great help from Brian Westbury. He did a thing in 2017 called The Fallacy of Weak Productivity, and he was all over this. Now, this is before Kathy Wood. Now, I'm going to talk about Kathy Wood in a minute here, but this is before I ever heard her name, and Brian Westbury of First Trust nailed this. He said the reason we don't see strong productivity numbers from the government is because they're part of the denominator, and the government is not that productive. So while a given industry in cloud, mobile, automation might have 5 to 10% productivity growth, you don't see it in the aggregate number. So that's the fallacy and sort of the hidden productivity. So where was the inflation? Well, inflation, we got to talk about Moore's law. Now, I like to have fun just looking at it from NVIDIA's perspective. If you want to have some fun, go to a Google image search and type in NVIDIA Moore's law, just NVIDIA Moore's law, any combination of that. They've basically reinvented Moore's law with GPU computing. Here, I'll show you some of the bigger charts because this was one of the graphics I used. Let's see, it's this one. This was the graphic I used in that 2017 report, the Technology Supercycle, because it just blew my mind. Here's Moore's law, where roughly speaking, chip power can double every 2 years and maybe half in size every 2 years, sort of leveling out into the 2010s. But the massively parallel architectures of GPU computing were reinventing Moore's law, basically. And here's also what's great about this is I love this image from NVIDIA. This is several years old, but it combines both the reinvention of Moore's law and what NVIDIA is really good at, this stack, the CUDA architecture. CUDA stands for Compute Unified Device Architecture. And it is a full stack of hardware and software that allows corporations to do their own automation or their own data analytics and deep mining and create new products and services. So, NVIDIA, that's why I continue to own NVIDIA. And, in the article version for this, I'll link to my most recent article for the 4th of July. I wrote about NVIDIA as bull of the day and really try and put together the whole story again, including some recent information. We scroll down to the bottom, and I talk about, like, you got a guy who I can't even remember BMO. He takes the street high price target $1,000 on NVIDIA, but there were some people who were already there. I was one of them. I went to 750 in April, and then 1,000 in May. And the analyst from Jefferies is a rock star. This guy has been, he's been in the industry for over 20 years, and he just really knows his stuff. Mark Lepacius. But the breaking news on NVIDIA in the past 2 weeks was that the management, well, number one, the UK said you're free to proceed with this acquisition. They said they didn't find any antitrust issues and they were done with their investigation. Number two, the ARM people that NVIDIA is trying to buy ARM, they said that this merger is better than the IPO. It'll give them more leverage and access to grow the way they want to. So check that out. I'll link to that. But back to the GPU roadmap. Here's another great image of how, and I talk about that in my article, of how you talk about just going back to 2010. Jensen Huang used to call some of their GPU architectures and cards, they had a Tesla model. They've since dropped the Tesla name to avoid confusion, because now they build supercomputers for Tesla, the car company, so they don't want to call any of their components Tesla anymore. But look at the acceleration. These cards just keep getting smaller as he goes below 10 nanometers, and then just stacking thousands of these cards. I mean, in a shoebox, one can hold 20, maybe 40 billion transistors, and then you stack thousands of those together, you get a GPU supercomputer. And so here's Volta in 2018, and so that's another idea of ramping the power of NVIDIA's massively parallel architectures. I did here's the if you want to learn more about what I mean by massively parallel architecture, here's a video I did in March of 2017, get your MPA in deep learning. And here's just a shot of what you're talking about with thousands of GPU cores that can process simultaneously versus Intel CPU cores. But now NVIDIA is going to have dual capabilities because they're buying ARM, so they'll have CPU capabilities. One other cool thing I want to show you here in this. So here's a good graphic. This is an NVIDIA graphic, but an Antec borrowed it. Just how when you stack the GPUs and you work with the CPU, the processing power you get. So, boy, there's me with a pink shirt on. All right, what else are we looking at here? So we talked about inflation, and one of the economists at Vanguard, Joe Davis, was all over this too. He says Moore's law is about more than smartphones, TVs, and Amazon Prime. It's the knock-on effects, and when you increase efficiency and reduce cost, it's providing deflation everywhere. When I showed that graphic for so here would have been where the graphic was for NVIDIA. This is the way NVIDIA explains it. For 30 years, the dynamics of Moore's law have held true, but now GPU computing is reinventing that, and basically you're talking things like, I mean, Jensen just throws these numbers around, but he's got the engineering to back it up. You're talking about 500 to 1,000 times increases in speed. I think that's one of his charts here. Yeah, here's Jensen, but during a presentation. This is probably in the past 3 years where they did a training, an AI training, and the scale was incredible. They 500x'd it in 5 years. So, if that's any proof. All right, so I want to show you this a quick segment of Kathy Wood's most recent deep dive. She always does something on Unemployment Day, and here she is talking about inflation versus deflation, and where the pressure points are. So just a couple minutes here with Kathy.
I think we might be on the flip of that right now. The bond market is signaling there are more deflationary pressures brewing out there, we believe, than most investors appreciate. I've just mentioned the good deflation associated with innovation, but the other side of that is creative destruction and the deflation that will hit companies who have leveraged up to buy back shares, manufacture earnings growth, have not invested enough in getting ready for the new world. And believe me, every sector is going to be transformed. And so they will face significant pricing pressure as their products really go obsolete eventually. And then the cyclical deflation. Well, the bond market seems to say this is what's happening. And if that is true, because most people don't believe 1.5% is a real interest rate, they've been normalizing, I think, in terms of the way multiples have worked out in the market, the equity market. They've been pricing or valuing stocks as though the normalized interest rate is somewhere around 4%. What if it's not? What if it is half of that? That would be huge for secular growth companies, especially because there's going to be so much confusion. You have all of this innovation, which is going to be very exciting, and then you're going to have all of this destruction, which is going to be pretty demoralizing. It's going to be so important to get on the right side of change. So, part of our mission and value is to educate. We know robots are coming to satisfy or to take care of wage inflation problems. Today in our brainstorm, we were talking.
All right, I'll stop there with Kathy. Her stuff is always good, usually much longer than mine. Here, this is a 37-minute video, but the cool thing is now with this YouTube technology, you can splice it in time market, right? So you can look at the topics: fiscal policy, monetary policy, bond market rally, oil prices, employment report, auto sales, consumer spending, retail inventory. Hey, if all that stuff bores you, you can skip the first 25 minutes and just go to something where she's talking about the market or cyclical deflation, or you can go right to the end. She has a few cool words about Tesla and then crypto. So, as always, must watch, and always stuff to learn from Kathy. So let me kill a few of these things here. Oh, one of the most recent things, she did this on July 10th. I just bought back into Invitae myself. We had an ARC genomics bubble, granted, right? She ran stuff up too high. I had a 200% gain in Editas Medicine, which I watched vanish. We just took a big gain in Intellia Therapeutics, though. And now I'm back in Invitae because the price has been stuck under 30 or around 30 here for 2 months. And so we took the tax loss sale on a loss, and now we're back in. And so she's got some research here from her genomics guy, Simon Barnett, about how Invitae is leading in all these different markets. And remember, the cool thing about Invitae is they're combining genomic sequencing, then sort of an information database with AI, and in an era where there's going to be a lifetime of testing options, that are customized for what we can call smart health. And Invitae is at the forefront of that. So, if they're not an acquisition target, I don't know who is. All right, let's. So we talked about BlackRock. We talked about. We talked to Kathy. Trying to see what else. I had a couple more things here I wanted to show you. Get rid of that. Get rid of that. So we talked about productivity, the technology super cycle. And I throw it on productivity, but it's just change in outputs over change in inputs, and so that's why the government productivity numbers, don't really tell us a whole lot. All right, a couple weeks ago, I did AI Dreams and Reality: Investing in Advanced Technology. I'll link to that in the article version. As always, there is an article version of this video on Zacks.com where I'll have all the links. And so, in the meantime, so coming back to Morgan Stanley and their 15% correction thesis, yeah, hey, I'm not going to say they're wrong. I thought that we'd get a bigger correction in the NASDAQ in May, but the buyers just came for it. And so I'm saying I believe that a correction will be in September. That's just, and maybe I'm just being too seasonal, but I thought that since the hungry buyers came in June, and that now we're just going to either drift sideways or higher in August. But so when the correction comes, you want to be a buyer, whether that's an 8% correction. Have your watch list, have your buy levels for individual stocks. When they get trashed 20 or 30%, you got to be there with a limit buy order to get your bucket filled, or you won't get them, because the algos will flush the stops and then they'll bounce right back. But in the bigger picture, what we're trying to ask is, what if these analysts, say at Morgan Stanley, aren't seeing the idea that maybe the real interest rate going forward in this era of technology innovation and deflation is really 2%, and the secular deflation of technology will continue to overrule some of the hot spots in inflation that we're seeing now? That's the big question you ask going forward, but I think it makes you a buyer during any corrections. All right, thanks for joining me in the kitchen. We'll talk to you next week.